Greg, why don't we start with you? Taking a look at U.S. futures under heavy selling pressure. I want to ask you why. The president telegraphed all these moves well in advance. Why do you think we're seeing such a sell-off in the pre-market?
Well, I think you can have one shoe drop, Frank, but when you have multiple shoes dropping at the same time, perhaps it lends itself for the market not having discounted everything. And right now we have the shoe dropping of hardline against immigration and deportation, which has an inflationary impact of its own. We have DeepSeek, which sent some jitters down the tech market. And now we have the tariffs, and it seems like it's just the beginning and that we are using them as a cudgel that is going to spark a retaliatory response. Based on economists I've trusted, I've talked to this week, this could add about 70 bips to a point to core inflation and maybe a 3-point hit to earnings, just the measures we've seen thus far.
Yeah, we did have Joyce Chang from JP Morgan on our air here on Worldwide Exchange a few days ago saying that everything wasn't priced in when it came into tariffs, and it appears she was definitely correct here. Jimmy, I want to come over to you. So there were some reports that Scott Bessent would push for the tariffs to be ramped up gradually. Then we saw some other reports that it was just a negotiating tool. The president was going to try to talk to these countries about a number of issues that he had on his mind. But then we've seen these tariffs be officially implemented. What does that do for the economy here in the U.S. and also the global economy? Just, I guess he telegraphed it, but it still seems rather sudden.
He kind of telegraphed the wrong thing. He telegraphed that these were going to be ramped up slowly. They're going to be kind of targeted. And I think obviously a lot of people on Wall Street were assuming that was going to be just that. Targeted, ramped up, probably temporary tariffs. Now here we are. They weren't ramped up. They don't seem particularly targeted. So now all Wall Street is left with is temporary tariffs. And I know, like, Goldman Sachs, they're still expecting these tariffs to be temporary. But I don't think that's an assumption we can necessarily hold to. I would love to hear from the Treasury Secretary right now. What is his current theory of the game? What is the end game for these tariffs? Because if I was an American business person, I'd be thinking, is this my life for the next 4 years? Tariffs, even if these tariffs get negotiated, what's to prevent the president 6 months from now, a year from now, saying, guess what? I don't like that negotiation. We're doing it all over again.
So, Jimmy, what you're really talking about is uncertainty, specifically for business leaders and even for governments. In your mind, what does that do for investments, even for the companies that want to invest here in the U.S.? Does that change their outlook? And certainly when it comes to investments outside the U.S. that are designed for companies that want to get into the U.S. market, how does that impact things?
Yeah, listen, on one side, you have the president talking about deregulation, tax cuts. That's all great stuff. Now, on the other side, you have a highly uncertain trade war that's happening right now. All that other stuff might happen. This is actually happening. So if you're in business, I don't see how this doesn't have a paralyzing effect. If you think this is how the U.S. is going to run its economy for the next 4 years of going from one crisis to another based not on not on an obvious theory of the case. Is the goal here trade surpluses with everybody? Is the goal here de-dollarization, or is the goal here that the president sort of really believes ideologically in tariffs and likes doing deals, and when there's tariffs war, it's a constant churn of deal making? I think that is an absolute perfect recipe for investment freezing uncertainty.
All right, Greg, I want to come back to you. So a lot of uncertainty about the president's policies, but there is one consensus out there that the tariffs are going to hurt the U.S. economy. I'm looking at an EY estimate. They believe it's going to be a 1.5 negative impact to GDP this year, 2.1% next year. As an investor, does that change your thesis when it comes to certain sectors or investing in certain parts of the market?
It does. And I think Jimmy hit upon this with what he just said. There's lots of things that would spur GDP growth and spur earnings growth, like deregulation and corporate tax cuts. But then when we have not only the actions we've seen thus far, but uncertainty around what further actions and what further retaliatory responses we'll receive, which certainly have a meaningful impact to GDP and earnings growth, we have no compass in terms of where to value things. We have no compass in terms of what a reasonable valuation is, because we have no compass on what earnings growth is going to be. And it is earnings growth that determines valuation more so than static earnings levels. And so, as Jimmy rightly said, I think this puts us at a posture where we have to consider taking risk off right now until there's some clarity on the way forward.